1837, the panic hits. Banks collapse, businesses fail, unemployment surges. Real estate values crater 80%. Most investors are completely wiped out. But one man, John Jacob Astor, quietly buys Manhattan real estate for pennies on the dollar while everyone else is busy selling. Fast forward, he becomes America's first multimillionaire. His descendants still own prime Manhattan real estate today. Same pattern, different crisis. 1929, the Great Depression. Fisher loses everything. Smart buyers acquire buildings at 20 cents on the dollar. 1981, Volcker spikes rates to 20%. Sam Zell buys from bankruptcies. Persian refugees buy up almost all of Beverly Hills. 2008, financial crisis. Barry Sternlicht raises $5 billion and buys hotels at 30% of replacement costs. And my friends, it's happening again right now. $1.5 trillion in debt is maturing. First owners are panicking. Second owners are positioning. The pattern that has repeated for 200 years. First owners get destroyed. Second owners build dynasties. Let me show you how. Let me take you back to 1837, the panic. Here's what is happening. President Andrew Jackson issues the Specie Circular. He demands that all land purchases be made in gold or silver, not paper money. His goal is to curb speculation. His result? He triggers a banking crisis. State banks have been printing money recklessly, fueling a land speculation bubble. When Jackson demands payment be made in hard currency, people rush to exchange paper for gold, and the banks don't have it. So within months, banks collapse. And very soon, 343 of 850 banks have failed. Unemployment hits 25% in some cities. Real estate values tank. The Depression lasts 7 brutal years. Most real estate investors in this environment are completely destroyed. But there's one man who not only survives, he thrives. My man, John Jacob Astor. Astor had arrived in America in 1784 with nothing. He worked as a furrier. He built a fur trading empire. And then he did something unusual. He started buying Manhattan real estate, not to flip, never to flip, to hold. And here's what separated Astor from everyone else he worked with. He paid cash for everything. So while his competitors leveraged up with cheap credit in the 1820s and 1830s, Astor hoarded profits. Boring, unpopular, essential. He leased his properties instead of selling. This gave him steady cash flow even during downturns. While others owned buildings they couldn't afford to hold, Astor had income coming in constantly to cover his costs. Number 3, he only bought in prime locations, lower Manhattan, the best corners, the land that would always have value no matter what the economy did. So when the panic of 1837 destroys everyone else, Astor is sitting on zero debt, steady rental income, and healthy cash reserves. And he sees something nobody else can see. Forced sellers are everywhere. So imagine you're a land speculator in 1837. You bought property in 1835 with borrowed money, paper notes from a state bank. You were going to flip for 2x profit. Then the panic hits. Your bank collapses. The paper you borrowed is worthless, but your debt is not, just to be clear. So the creditors demand payment in gold, which you don't have. You must sell. You are desperate. And then John Jacob Astor walks up. He offers you 20 cents on the dollar, and you take it because it's either that or you lose everything anyway. By the time the panic ends, Astor owns massive chunks of Manhattan, properties he bought for pennies. He famously said later in life, "Could I begin life again, knowing what I know now, and had money to invest, I would buy every foot of land on the island of Manhattan." Astor died in 1848, worth $20 million. That's around $700 million in today's dollars. But here's the kicker. His family still owns prime Manhattan real estate. The Astor family office, Waldorf Astoria, is named after his family because he never sold. He leased, he held, he compounded. Classic second owner. Now fast forward 140 years. Another crisis, different playbook, same pattern. 1979. America is in crisis. Inflation is 13%, unemployment is 7%. President Jimmy Carter goes on national television and tells America, we've lost our way. The crisis of confidence speech. And then Fed Chairman Paul Volcker does something unprecedented. He spikes interest rates to 20%. 20%. Within months, real estate financing stops. Properties bought with cheap debt become veritable death traps. Foreclosures are everywhere. Developer suicide rates spike. Unfortunate side effect of every single bear market in history. And a 37-year-old guy named Sam Zell, he's not running, he's buying. So picture this. You're a real estate owner in 1981. Your office building's half empty because businesses are shutting down. Your mortgage is coming due. You call the bank for a refi quote. 18% interest rate. You can't refinance at 18%. You bought this building with 7% debt. The math does not work, but you can't sell because nobody's buying. Transaction volume is down 80+%. You are drowning. Your family's watching. You haven't slept in weeks. And then Sam Zell walks into your office. He doesn't offer you market value. He offers you 30 cents on the dollar, and you take it because it's either that or the bank takes it for zero and you lose everything. That is a forced seller. That is a second owner opportunity. But here's the thing you got to understand about the grave dancer himself. He didn't get lucky. He had a system. One, he built liquidity during boom times. While everyone else was expanding with leverage in the 1970s, Zell was hoarding cash. Boring, unpopular, but essential. Two, he targeted fundamentally sound properties that were crushed by bad debt. Not bad buildings, good buildings with bad balance sheets. The locations worked. The bones were solid. They were just over-leveraged. Three, I love this one. He negotiated directly with desperate banks. Banks holding foreclosed properties do not want to be landlords. They want out. Zell gave them an exit at his price. Number four, use long-term fixed-rate debt. This is the key. While rates were at 20%, Zell wasn't borrowing at 20%. He structured deals with seller financing, creative debt, and long-term fixed rates that insulated him completely. So by 1985, while his competitors were still shell-shocked, still bleeding, Sam Zell controlled one of the largest commercial real estate portfolios in America. The press gave him a nickname that has lived forever, the Grave Dancer. He was buying properties from the financially dead. But here's the thing. Zell wasn't celebrating failure. He was prepared for failure. He'd spent the entire 1970s boom getting ready for this exact moment. While everyone else was partying, he was building cash reserves and operational systems. First owners panic. Second owners prepare. That is the pattern. Now, let me tell you another story that's going to blow your mind. And I learned about this recently, and it's fascinating. 1979, similar, same time frame, same panic, same story. The Iranian Revolution. Ayatollah Khomeini takes power. Thousands of Iranian Jewish families flee for their lives. They grab whatever they can carry, jewelry, cash, gold, and they escape. And many land in Los Angeles. And they arrive at the worst possible time. Volcker's rate hikes, mortgage rates, real estate markets frozen, transaction volume dead. And every American investor is paralyzed by fear. But the Persians, they're buying. The Mahbubia family arrives in 1980. They've lost everything in Iran except the wealth they smuggled out in gold and jewelry. They look at Beverly Hills, Rodeo Drive, Westwood, prime locations, and they see something. These locations are not going anywhere. And importantly, they had the education, training, and cultural background to value real estate, to believe in the long-term value, and to strike when the iron was hot. So they go for it. In 1981, the absolute bottom of the market, they buy their first Rodeo Drive commercial building. The sellers are desperate. Rates are 16% plus. Nobody else is bidding. Americans won't touch it. The Mahbubis pay cash. No bank, no financing risk. They just buy. The same year, other Persian families are buying apartment buildings in Westwood, shopping centers in Los Angeles, West LA, office buildings in Century City. While America's panicking about inflation and recession, they're quietly accumulating some of the most valuable real estate in the country. Fast forward to today, those families, they own some of the most valuable real estate on earth. The Mahbubi family's Rodeo Drive building is conservatively worth 10 to 15x what they paid in 1981. Their secret wasn't timing the bottom. Their secret was liquidity when no one else had it. They had converted everything they had to portable wealth due to situations way beyond their control. No fear of bad headlines. They had survived a revolution. America was the land of opportunity. They didn't care about high rates. They wanted to build something, own something. Number 3, purchase on location fundamentals. Great locations always recover. 4, cash purchases. 0, refinance risk. Classic second owner. So here's where this gets interesting for you and for me as we're thinking about what to do right now. Let me show you 2 investors. Both started with $500,000 in 2021. Investor A buys a, Sunbelt multifamily property. Purchase price $12 million, 3.8% cap rate, bridge debt at 4% floating or less. I got bridge debt at this time. I think my initial rate was 4% when the treasury was under 1%, right? I mean, it was like unbelievable. 3-year refinance plan, underwritten for, call it 7 to 12% rent growth. It seemed brilliant in 2021. Everyone was doing it. But investor B does nothing. And I knew guys like this over this time. They were patient. They waited. They sat. They bided their time. They sit in cash. They watch. They take heat from their friends for missing the markets. They get called a coward on Bigger Pockets forums. But investor A today, rents down 8%. Bridge loan matured. Refi quote, 6 to 8%. Can't cash flow. 2 options. Inject $3 million of new equity or give the keys back to the lender. Underwater, losing sleep. Their marriage is likely very strained. Investor B today maybe could buy that same building for $7.5 million. 7+% cap rates, 5-year fixed rate debt in the mid 5% range, cash flowing day one, sleeping very well. Who made the right choice? Hindsight's 2020, I understand. But one didn't get caught up in the euphoria, one did. The one who made the right choice is the one who understands the cycle. So which investor are you? Because right now, today, we are in the middle of this transition. First owners are panicking. Bridge loans are maturing. Equity is getting wiped out. Second owners are positioning. And I'm going to show you how to take advantage of this because here's what's happening right now. $1.5 trillion in commercial real estate debt matures between now and 2027. Most of it was originated at market peak, our investor A scenario, and the math just doesn't work. Many of these properties cannot cash flow anymore. These are your first owners. Many of them, not all, but many are about to become forced sellers. So here's your 5-step playbook. Number 1, start building your cash reserves right now. Get ready. If you haven't already, start building, prepare. Or if you're looking to raise capital from investors, start having those conversations. I talk to syndicators every day who say, I want to get into the business. This is the time to get into this business. Stockpile cash, stockpile equity, stockpile investors, preserve dry powder, look for the right deal. 2, lock fixed rate debt. Second owners never use floating rate debt, period. We are locking loans on deals right now, 65% leverage, fixed rate for 7 years, sometimes term interest only on the investment. These are deals that are trading at 40, 50% discounts from things that we saw before. Third, focus on cash flow, not IRR dreams. I don't care about your exit multiple assumptions. I care about cash flow yields day one. 8 to 10% cash yields with fixed rate debt. That's the bar. Find it, strike. Cash flow is the truth. Everything else is just a story in this business. Number 4, hunt forced sellers, not motivated ones, although those are good too. But there is a difference. Motivated sellers want a good price, but they can walk away. Forced sellers must sell or they lose everything. Target bridge loan casualties, fund life cycle forced exits, right? A fund that has to get out right now. Estate settlements are great. Great place to look. Partnership blowups. A partner wants out of the deal. They've got to get out. These are coming. They're everywhere. They're multiplying weekly. Number 5, buy supply constrained markets. The Persians bought Beverly Hills. You cannot build more Rodeo Drive. Zell bought irreplaceable office locations. We are buying 1920s vintage turn of the century assets in locations that are incredibly difficult to build in. You cannot build them. The cost of building new assets in these locations is many, many, many times the cost of the buildings that we're acquiring. That is a really interesting example. Let me show you exactly what I'm doing. We put a deal in Portland in contract. And yes, I know some of you don't like Portland. I got it. We love Portland. We think it's great. 54 units, 40% discount from the pricing that the sellers have previously seen, right? A 7.25 cap going in purchase price, 7-year fixed rate debt in the low 5% range, annual cash yields of 10 to 15% on this thing. Sit on it, hold it, cash flow it. Even if there is no equity appreciation, investors are still receiving a 10 to 15% yield, but there will be because we're striking at the bottom of the market. We're taking advantage of some serious market mispricing. This is what second owner opportunities look like in real time. The Sunbelt competitors that we have had in our business with bridge debt at 3 caps, they're the first owners and they are toast. So here's the truth nobody really wants to hear, but it's important to discuss. This is already happening. Right now, as you're watching this, bridge loans are maturing. Sponsors are getting margin calls. Properties are getting handed back to lenders. It's happening all over the place. The transition from first owners to second owners has begun. Dr. Irving Fisher was brilliant, but leverage destroyed him. Carnegie bought steel mills in the 1873 panic. He became the richest man in history. Sam Zell danced on graves during the S&L crisis, and he built a billion-dollar empire. The Persians bought Beverly Hills in 1981 when Americans wouldn't touch it, and they created dynastic wealth from smuggled gold and cash that they got out of Iran. The pattern never changes. Cheap debt creates overconfident owners. The cycle turns. First owners become forced sellers. Second owners with liquidity buy the distress. Second owners build the empires. So right now you have a choice. You can be a first owner, chase the next deal, adding leverage, hoping rates drop, praying your bridge loan extends. Or you can be a second owner, building cash, preparing systems, hunting for sellers, positioning for the greatest wealth transfer opportunity in a decade. If you're an accredited investor and you want to see how we're executing this playbook in real time, check the link below in the comments. I'd love to talk further about some of the deals that we're seeing in these markets. If you're an operator watching this, I don't care if you steal this entire framework. Build cash, lock fixed debt, hunt for sellers. The world needs more second owners. And if you're sitting on a bridge loan that matures in the next 18 months, call me. I'm interested. Love to hear more about your property. My friends, the wheel turns ever onwards. This cycle will never cease because humans are humans, and we are the only factor that keeps repeating time and time again throughout history. Think well, act wisely, build something timeless.